presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compac Market Wrap YouTube update for March the 16th, 2026. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. Let's start with, first of all, reminding all of you, click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. Also go to compac.com if you want a longer version, more detailed version of this YouTube update, and click on Insights, and there's a podcast there. And you have all the episodes there where Javed and I go into more detail, and you can listen to that at your convenience also. If you need help with your portfolio, send me an email at invest@compac.com or just give me a call at 800-388-9700. Let's start with the numbers. Everything was down last week as the war in the Middle East continued and the war against Iran, and oil continues to move higher. S&P was down 1.56. Dow was down 1.91, Nasdaq was down 1.23, and the emerging markets in Europe was down even more. And the growth market was down, small cap was down, everything was down last week as the reality starts to set in that there is really no solution or a very tough solution for the Iranian drone attacks that we're seeing all across the UAE, and all the Gulf countries are being attacked, and there is really no solution for that for right now. I mean, we've seen this go on with the Russian-Ukrainian war, where Russia has fired 120,000 drones at Ukraine over the last 4 years. But the war was expected to last a couple of weeks when Russia went into Ukraine. Same thing here. The problem is, I think the perception was that if we decapitate the Iranian regime, they would crumble and collapse, or someone from the IRGC, which is the Iranian Revolutionary Guard, would come along, make a deal with the Trump administration, say, look, you can take out the uranium, we're not going to make any more nuclear bombs or move towards that, you can take, and we will work with you, similar to what happened in Venezuela. That did not happen. And now we're sort of in a situation where they've closed the Gulf of Hormuz. It's causing global economic pain. Even though we have more crude than we use, we produce more on a daily basis. We export crude oil. But crude oil prices are set on a global basis. So when 20% of the oil is not coming to market, not coming through the Gulf of Hormuz, that is causing a problem in prices. Oil prices were up. We saw energy was up last week. Oil prices moved up to $98 a barrel. That's what we saw. Today, they're down a little bit, and we will see how long it takes, or if we can really open the Gulf of Hormuz. If we can't, and it'll take time, or we have to send ground troops in, it will take time. We can do it, but it'll take time, and it'll make a larger commitment, longer commitment, and that is what the market is sort of looking at this point. Until this Gulf of Hormuz opens, I mean, with the Iran war, it wasn't directly a financial problem. But with oil prices going up and the Gulf of Hormuz being closed, that is the waterway where all the oil from most of the Gulf countries goes through, close to Iran, and comes to the world. That is only 22 miles wide, and it is not very wide. You can see across it, so if you see a tanker going through, they can shoot drones or missiles or whatever at it, and if it's very dangerous to escort ships through there. Also, if you put U.S. Navy ships in between the Iranians and the tankers, then the U.S. ships become targets. So we will see how long this takes, and this could cause a longer-term volatility in the market. I think today the market is up nicely as oil backs off a little, but we'll see how the outcome goes. Also, it is pushing up the expectation of inflation. As oil prices go up, inflation goes up. As inflation goes up, so do interest rates. They're at 4.228 compared to 4.15 the week before. There's a Fed meeting this week. Not much is expected from that. No change in interest rates. Probably tomorrow or Wednesday is going to be announced. Here's the traffic going through the Gulf of Hormuz. There were about 175 ships going through on a daily basis, traffic through, you can see that it has come down to virtually nothing. And you can see that it was somewhere between 150 ships going through. So looking at this, it is a problem. Until we solve this problem, it is going to cause volatility and anxiety in the global financial markets. GDP numbers, it was revised downwards to 0.7, which is barely eking across. CPI rose to 2.4, PCE, that's a personal consumption expenditures index. That's the Fed looks at that as the inflation gauge. That was up to 3.1%. Looking at this data, not a lot coming out this week, but the big announcement will be the Fed, and then the Fed meeting or the press conference by Jerome Powell. What does he say about inflation? What does he say about the war? Looking at the technicals, we've broken down, we've made a fifth wave top. This is wave 1, wave 2, wave 3. We're sitting right at the 200-day moving average. 66.74 was the low today, but on Friday we got very close to that 6,600. If we break 6,600, then this is the support right here, about 6,500, and that's where we get down to. If we can, probably you'll get a bounce here on wave 4, and then wave 5 to the downside is what I'm looking for. Can we hold the 200-day moving average? We'll have to wait and see. On a weekly basis, 64.62 is the 50-week moving average. It's moving up, so by the time we get there in a week or so, probably this will be right around 6,500 or so. So we've broken the 20-week. Is this going to be just an A, B, C correction? A, B back up, C back down, or do we start a wave count to the downside? Here we saw an ABC right here, right on this side before we started a wave count to the upside. So we'll have to wait and see. Nasdaq got below the 200-day on Friday, came back up today, but bouncing around here, just going back and forth. What more concern is the daily dot plot on the weekly. So the weekly dot plot, you can see now the dots are above the market. This is the market right here, and these are the dot plot right here. These are the dots when the market is going up. They're below the market. This is the market. This is the dot plot. And you can see now the dot plot. When the dot plot is above, the dots are above the market, you can see what happens. It goes down. And that's what we saw last April. And it goes down for a period of time. Here was about 12 to 15 weeks on the downside. So when we turned down and the dot plot turned negative last week, I said this could last for a few weeks. We're in the third week right now. And probably we're looking at 21,522 is the number that I'm looking at as the support area. We're 22, for about 1,000 points lower is what I'm looking at as the first support level. If it gets below that, then we're looking at somewhere around 20,000, which was right around here. This number right here becomes your support area. Small caps also breaking down, getting below the 20-week moving average, moving towards the 50-week moving average. We're looking at international stocks. We're down below the 20-week. Today we're back up, but real support is right here, about 81. That's for the ETF, IXUS. Looking at the Treasury yields, they were sharply higher, got up to this resistance area on 4.3 on Friday. Today we're back to about 4.22. Support is at 4.19. If we get much above 4.3, then we start looking at somewhere around 4.5 as the resistance area, which is right up here. And that could be a big move in rates to the upside. And that definitely could cause people to worry about inflation coming back. Gold ETF not really going anywhere, sort of sitting around here, going back and forth, support at 453.80, which is the 50-day moving average. High yield bonds broke down 2 weeks ago, and that's what we saw. That was an indication of more downside to come. Today we're back up a little bit, doing much better than the bond market overall. Interest rates on the U.S. government bonds are going higher, so that yield is going higher and putting. So HYG is holding up much better, which is a junk bond, which is good. Again, if you'd like to, don't forget to subscribe to this channel whenever I post an update. If you're worried about your portfolio, send me an email at invest@compact.com or just give me a call at 800-388-9700. Now is the time to make sure you have the right allocations, you have the right mix of assets. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.